FXN Mentoring, what's up, guys? Welcome to FXN Mentoring and welcome to week one. Guys, welcome to Trading with Market Makers. And yeah, this is going to be a very, very special 12-week course. And so I hope that everyone gets as much as you can out of it as you can. I hope that everyone gets as much out of it as you can. So this week in particular, guys, is going to be very, very busy. It's going to have a lot of stuff. So please, please, please take notes. And you may have to rewatch this video a second time because there's a lot of stuff that I want to get through in this first week right out the bat. All right. So let's jump right into it. And the first thing I want to do is I want to talk to you guys about expectations versus reality. It's something that I do with every course during the first week. And I really just want to emphasize the expectations versus the reality of what this is. So I want you for the next 12 weeks to forget about everything that you possibly think about or know when it comes to trading Forex and open up your mind to the possibility of new things. Okay? And we're going to walk you through the process of how we trade step by step every single week. And we're going to break down concepts with you, for you, every week through the videos. You're going to learn how to implement it through the homework, and you're going to hopefully be able to retain the information and be able to pass the test every week. All right. So the first thing is expectation versus reality. Everyone must have expectations. I get it. And for most of the people that come through the course that I have found that have come through the course, their expectations is that after 12 weeks, they're going to be a master trader and they're going to be making millions of dollars, right? The reality of that is that the 12-week program is just 12 weeks, right? It's just 12 weeks in your career as a trader if you want this to be a career. But it's definitely going to be a hell of a lot harder than just going through 12 weeks of videos. Okay, it's going to be a lot of time commitment on your end to put everything together. One thing that I can tell you is that for the next 12 weeks, I'm going to give you 120%. And I would expect to get 120% back from you. All right? So, if you have any expectations of becoming millionaires right after 12 weeks, the reality is you're not. The expectation that you might be able to quit your job after 12 weeks versus the reality of it that you should not quit your job after 12 weeks. Also, if you don't have a job right now and you're literally counting on this to be your full-time income, I would strongly recommend for you to get a job. Because there's nothing more stressful in life than trying to trade Forex or trade really anything, whether it's stocks, crypto, options, whatever, knowing that you have rent to pay the next month, car payment, insurance payment, whatever. All right. So if you don't have a job, go get a job first. Honestly, go get a job first because that's going to relieve so much pressure. This is going to take time for you to learn this. I don't expect you to be perfect. I expect you to make a lot of mistakes. I expect you, though, to learn from the mistakes and not to repeat them once I point them out to you. I expect you to have an open mind and to give it your all throughout the next 12 weeks. Because if you really take it seriously, the next 12 weeks, you're going to have a really strong foundation to start. And this is literally just the beginning. After the 12 weeks is just the beginning. So it's not the end. So forget about all the stuff that you see on Facebook, Instagram, your favorite YouTubers showing you whatever, $2 million in the last month or whatever the case may be. All right. The reality of trading is that it's hard as hell to do because the emotions, the psychology. The trading part, I think, is the easiest part because you're just buying and selling. You're pressing a button. It's what happens afterwards that makes it the hardest thing. All right? And it takes years to build an account. Nowadays, you have a huge advantage, which is prop firms that could fund you or give you money to trade, right? So you no longer have to have 10, 20,000 of your own money to put down in a trading account. Now, if you know how to trade, people will give you money to trade. They'll give you $50,000, $100,000 to trade. And you can literally make 5, 6 grand a month on a regular basis using somebody else's money, right? But the problem is that you have to learn how to use other people's money, how to correctly trade markets. And so that's what we're going to teach you over the next 12 weeks is how to do that. So hopefully, if you have that aspiration of becoming a funded trader or through FTMO or through, a bunch of the other prop firms that are out there, it could be a reality for you. That is definitely something that could work out for you. And I'm here to help you along that journey as much as I can. We have several of our traders who are funded traders. Several people who don't need to be funded, they just go off, from their own money. But we have had several traders who've gone through to become funded traders. So it is possible. It's not easy. It's a hell of a lot of work. It's going to get hard. It's not easy. But you can do it. All right? So let's get right into it. And the first thing I want to do is I do this with every class, and I want to know how well do you think like a trader? So the first thing that we're going to do is we're going to take a quick little Q&A. This is actually going to be part of your first homework assignment for week 1. Okay? So I want you to answer the questions that I'm about to present to you. Just a real quick with agree or disagree. So get out a pen and paper, notebook, whatever, notes on your phone, iPad, and just answer these questions for me. Okay? And you're going to turn these in this week. All right? So the first question is, to make money as a trader, you have to know what the market is going to do next. Agree or disagree? Sometimes I find myself thinking there must be a way to trade without having to take a loss. Do you agree or disagree? Making money as a trader is primarily a function of analysis. Losses are an unavoidable component of trading. Agree or disagree? My risk is always defined before I enter a trade. In my mind, there's a cost associated with finding out what the market might do next. Agree or disagree? Next one. I wouldn't even bother putting on the next trade if I wasn't sure that it was going to be a winner. The more a trader learns about markets and how they behave, the easier it will be for him to execute his trades. Agree or disagree? My methodology tells me exactly under what market conditions to either enter or exit a trade. Even when I have a clear signal to reverse my position, I find it extremely difficult to do so. Agree or disagree? And finally, I have sustained periods of consistent success, usually followed by some fairly drastic drawdowns in my equity. Agree or disagree? When I first started trading, I described my trading methodology as haphazard, meaning some success in between a lot of pain. Agree or disagree? I often find myself feeling that the markets are against me personally. As much as I might try to let go, I find it very difficult to put past emotional wounds behind me. I have a money management philosophy that is founded in the principle of always taking some money out of the markets when the market makes it available. Do you agree or disagree? A trader's job is to identify patterns in the market's behavior that represent an opportunity and then to determine the risk of finding out if these patterns will play themselves out as they have in the past. Agree or disagree? Sometimes I just can't help feeling that I'm a victim of the market. When I trade, I usually try to stay focused on one time frame. Trading successfully requires a degree of mental flexibility far from the scope of most people. There are times when I can definitely feel the flow of the market. However, I often have difficulty acting upon these feelings. Agree or disagree? There are many times when where I'm in a profitable trade and I know the move is basically over, but I won't take my profits. Agree or disagree? No matter how much money I make in a trade, I am rarely ever satisfied and feel that I could have made more. When I put on a trade, I feel I have a positive attitude. I anticipate all of the money I could make from the trade in a positive way. Agree or disagree? The most important component in a trader's ability to accumulate money over time is having a belief in his own consistency. If you were granted a wish to be able to instantaneously acquire one trading skill, what skill would that be? Think about that one. If you were able to grant one wish to be able to instantaneously acquire one trading skill, what skill would that be? I often spend sleepless nights worrying about the market. Agree or disagree? Do you often feel compelled to make a trade because you were afraid you might miss out? Although it doesn't happen very often, I really like my trades to be perfect. When I make a perfect call, it feels so good that it makes up for all the times that I did not. Do you ever find yourself planning trades you never execute and executing trades you never planned? Hmm. Think about that one. Do you ever find yourself planning out trades that you end up never executing, but executing trades you never planned? And then finally, in a few sentences, please explain why most traders either don't make money or aren't able to keep what they make. All right? So, on most of these questions, it's agree or disagree. And then, of course, you saw a couple where you can actually write in an actual answer. All right? So, this right here, answering these questions, are is going to let me know how well do you think like a trader right off the bat. We're going to ask these same questions at the end of the course, and you'll be able to compare your answers whether or not they're the same or different. And you'll see just how different you might think about stuff. All right? So again, this is for the first part of your homework that you'll be emailing to me. We'll get to the homework at the end of the video. All right, so now we've got that out of the way. The next topic: who are the market makers? Who are the market makers that control everything? So let's talk about this. So the main manipulation players, I call them, the manipulation players, are Citibank, JP Morgan, HSBC, UBS, Bank of America, and RBS, which is the Royal Bank of Scotland. There are plenty of others, but these are the major ones. These are the ones that control over 90% of what's going on in the market of Forex. And if you really want to get down to it, the creme de la creme is going to be Citibank. They hold most of the cards in this. They hold most of the cards. All right. So let's talk about what are the market maker intentions. The market maker intentions are pretty simple. The first thing is they want to initiate panic and fear in order to get retail traders to think with emotion. If they can get you to think with emotion, you're not going to be thinking like a normal trader. You're going to be doing things that you normally wouldn't do. Second is to persuade retail traders to take positions, right? They have to get you in a state of panic and fear with emotions because they have to persuade you to take actual positions, because without you being in the market, they're not making money. So they have to get you into the market. They have to persuade you to get into the market. Right? So after they get you into the market, then what do? Well, obviously, they want to hit your stop losses, take you out of trades, and clear all of the orders, or basically the liquidity. you have to understand that the market needs liquidity. You taking positions in the market provides liquidity, right? There's a reason, if you haven't heard of things, of topics like liquidity pools, liquidity grab, all these things are all basically, they all mean the same stuff, right? Just people call them different things. But at the end of the day, it's hitting stop losses, clearing all orders. It's the same thing. They force as many retail traders into margin call, right? That's the goal. Is to force as many retail traders into margin call, because that's how they're going to get as many traders as possible to blow their accounts. Let's talk about Forex manipulation. This is probably one of the biggest things. I need you guys to understand that market makers, right, they already know what they're doing. And in the sense that I'm talking about is everything is already pre-planned. Okay, so Euro USD going up for the next month or whatever, that's already pre-planned. Okay, the question becomes, how are they going to get up there? Euro JPY, let's say if it goes down for the next month, that's already been pre-planned already, right? If they want to drop at 800 pips, that's already pre-planned. The question becomes, how do they do it? How do they get there, right? So just understand that from the get-go, that everything is already pre-planned or already pre-made. Okay? So what can market makers do? Because they can definitely do a few things. The first thing is that they can requote your orders at any time. Second, they can fully control the spread. They can trigger stops in any range. They can hold a price level or extend it at any time. And they know which traders are in margin trouble. So these are the things that they can do, the things that they know. Specifically, the last one there with traders in margin trouble. So think about if you're Citibank and you have the ability to do all this stuff. Requote orders, have full control over spread, trigger stops in any range, hold and move and extend price in any area, and know how many traders or which traders are in margin trouble. Think about if you were a bank and you had that power, what would you do? Do you think you'd ever lose? If you had this ability? Of course not. So why would you want to go against that? Why would you want to go against that? Why would you want to trade against that? It doesn't make any sense. So from now on, you're no longer allowed to go against them, because you're going to lose every single time. So you're no longer allowed, privileges have been revoked. You're no longer allowed to trade against them. You only want to trade with them. Because at the end of the day, us as retail traders, right, me individually, you individually, Susan or Jan individually, we're literally just mere grains of salt on a beach. We're nothing, right? But when you think about all the millions of traders out there, that's a lot of money. That's a lot of easy money that they get over and over and over again. So what does it look like? So requote options. This is what it looks like when they can requote options for you or requote a price, essentially. Put in the numbers that they want to requote, send, confirm, reject, all of it. Triggering stops, right? They can go stop out unlimited. They can change it to 10, 20 pips, whatever they want to. Controlling spreads, that's what that looks like there. They can change how much ever spread they want. They can put up, 10, 20, 30, 30 pip spreads, whatever they want. Holding price levels, sure. Just enter the date, the volume, the price, high, low, close, hit OK. Here's the number of people that are in margin call. These are all their, they're all the account numbers and then the level of margin call that they're in or they're about to be in of their accounts. And then here is what essentially the MetaTrader 4 manager looks like, right? Of all of their customers' accounts, the sell lots, prices, net lots. I mean, everything is there. This is what they're looking at to control everything. Now, the question that you should ask yourself is, do market makers have restrictions? I don't know, do they? Can they do whatever they want? If they could do whatever they want, what would happen with the economy? If Euro USD were to drop 2,000 pips in an hour, what would that do? Think about it, right? So they can't just window 2,000 pips in an hour, right? Really doesn't work that way. So they do have restrictions. The number one restriction is the IMF restricts how much Forex markets can actually move at any given time. Typically, it's about 200 pips per day, give or take. If there's news like NFP or something like that, 200 pips could be just the US session alone, right? But the majority of the time, it'll probably be within 200 pips or less per day. Now, this number, this 200 pips a day, was completely different during the pandemic. This number was actually double that during the 2020 pandemic. If you go back into the charts, you go look at pound NZD, Euro NZD, Euro USD, pound USD. If you look at all those pairs from like March all the way through December, you'll notice that you literally had 150 pip Asian range, 200 pip London range, and another 150 range during the US session. It was really ridiculous, the amount of move pips that were being generated during the pandemic. So pandemic aside, right? Now that we're not through with the pandemic, but we're basically, on the outskirts of it where we can kind of have a normalization of everything, right? So everything's kind of back to normal almost. Also, they don't have unlimited equity. They do not have unlimited equity. Now, what are the market maker trap moves? What are trap moves? Trap moves are basically what market makers use to essentially trap traders. Okay? And so when we look at it, we can look at it from, the first thing is being a weekly view, or what I like to call a 30,000 foot view, right? A big, broad view. So you'd be looking at beginning of the week and at the end of the week. So market makers would trap traders at the beginning of the week, go the opposite way, and then turn right back around at the end of the week to trap them for to hold them over the weekend, right? And then we have a closer view, which is the day-to-day view. So you'd have basically traps being set at the beginning of the day and at the end of the day. That's more like the 10,000 foot view. And then you have the ground level view, which is basically at the beginning of each session and at the end of each session. So think of the 30,000 foot view as more like a bigger time frame, and then you got the day to day being like an hour chart, and then the ground view being like a 15-minute chart. So think of it like a 4 hour, 1 hour, and 15-minute chart. All right. Now, what are the hours? What are the sessions? What sessions do we really care about? Well, if you've watched any of the videos from YouTube, you know that our primary session, right, is London and New York. Everything else we really don't care about, right? Every day, the daily resets, meaning that the reset every day at 5 p.m. Eastern Standard Time, 5 p.m. New York time, everything resets and starts over again, right? So Sydney session starts at 5 a.m. or 5 p.m. Eastern Standard Time, 5 p.m. New York time. Sydney session starts. So what does that mean? It means that you're going to be having, you're going to get Australian and New Zealand starts trading. And then you're going to have, right after that, at 8 o'clock, you're going to have Tokyo start, basically the JPY pair start. And notice how Sydney and Tokyo are basically running right next to each other, right? So there's a reason why when you look at pairs that have NZD or JPY, you'll notice that the Asian session is typically a way bigger range on those specific pairs compared to other pairs. So if you look at, AUD USD or pound NZD or Euro JPY, because they have either a Sydney or a Tokyo pair in them, those specific pairs, you're going to notice that they have a bigger Asian range than any other pairs, right? So that's why you'll see those two pairs move a lot more than others, because their trading sessions are right there in the middle of Asia. Okay. Frankfurt, of course, is a Swiss, and I mean, I don't really trade the Swiss, so but they're running basically with London. But the ones that we care about, the two sessions that have the most volatility that we're going to be trading, is either London or New York. Whichever trading session works best for you. So as you start this 12-week process, and as you go through it the 12 weeks, I want you to start thinking about something. Start thinking about what session makes sense for you to trade. Think about everything that you have going on in your life, whether you have a job, whether you have a wife, kids. Take in everything that you're doing or that you have going on right now in your life, and just think about, okay, out of everything that's going on right now, what session best suits me? So meaning that if you're working a 9 to 5, right, a regular 9 to 5 job, right, likelihood is that you really should not be trading New York if you're like on East Coast time. You know what I mean? If you're working a 9 to 5, I mean, you're basically working the entire New York session. It doesn't make any sense for you to be trading New York when you can't trade and work at the same time. That doesn't make a lot of sense. So you're probably going to end up being a London trader. So take a look at your life. Take a look at everything that you have going on within your life right now and ask yourself, what sessions are going to be the best session for me, either London or New York? So let's go ahead and talk about now what's the market maker cycle. Okay. What we're going to do moving forward now is we're really going to start to get into the meat and potatoes of this video. We had to go through the basics of market makers and stuff like that. Now let's really get into the real stuff for this week, and these are the parts that I want you to definitely pay attention to. So what is a market maker cycle, right? This is the actual cycle that repeats itself over and over and over and over again in the Forex market, right? It's a pattern, bigger pattern that repeats itself over and over and over again. So let's take a look at it. So the market maker cycle looks like this. If you're in a downtrend, right, you have PFH, and then which basically makes a big M. You go down, okay? You go down, and then you make an A. You go down again, you make an A, and then finally you end with a W, which is PFL, which is peak formation low. And then if you were in an uptrend, you're actually starting with a W, and then going to a V, V, and then finally an M. So in short term, if you're in a downtrend, is MAAW, and if you're in an uptrend, it's WVVM. Okay. Now, a very important thing to keep in mind when it comes to this market maker cycle. The market maker cycle itself, by the way, is just literally, it's either or, right? It's either the downtrend or the uptrend. It doesn't, whichever one you're looking at or it's presenting to you. But the market maker cycle is not based off of time or days. Okay, so this is not a cycle that runs Monday through Friday. It doesn't care about days. It doesn't care about time. All right, and it also, it can this cycle itself can happen on any time frame. It doesn't matter. I can show you this cycle on a monthly chart. I can show you this cycle on a daily chart. I can show you this cycle on a 1 hour chart. I can show you the cycle on a 1 minute chart. So this cycle does happen on any time frame. It doesn't matter. Most of the time, right? This pattern or this market maker cycle starts with an M and ends with a W, right? So if you're in a downtrend, you'll start with an M, which is peak formation high, and then you'll end with a W, which is peak formation low. If you're in an uptrend, you'd start with a W and then end with peak formation high, which is an M, as dictated on the picture there. There will be some times when the cycle ends with a V or an A-shaped top or bottom, meaning that there will be times when you don't get a second leg to create the M. When that happens, it's going to be very visually easy to see, because typically it's done to grab liquidity from previous structure. And I'll show you what all of that looks like. But just know that there will be times when the cycle itself doesn't end with an M or a W, but it ends with a V or an A, basically a spike, and you don't get a second leg. But it's due to market makers grabbing liquidity from previous liquidity pools or structure. And again, I'll show you what that looks like. So the V or A shaped happens when the market makers grab liquidity from previous pool, what I just said. Okay. Now, a very important thing is that ideally, in a perfect scenario, in a perfect world, from the M to the W, from top to bottom or from bottom to top, ideally it's going to have 3 times the average daily range. Okay, so meaning that every pair in Forex has a daily average range, meaning all that means is that the average that a pair normally moves in one day, right? So let's just say, for example, that on the picture here, AUDJPY, right? Let's think about that pair and let's just say, pretend that that pair has, on average, it moves about 50 pips per day. Okay? So 50 pips per day times 3 is what? It's about 50 pips, right? So 150. So 50 times 3 is 150. So meaning that a cycle on AUDJPY should typically be about 150 pips from top to bottom. So from M to W or from W to M. 3 times is the ideal perfect scenario. Now, of course, we're not working with ideal and perfect scenarios, right? If it was like that, we wouldn't even be here. We'd all be millionaires, right? So, what's the actual real range that in real life scenarios you'll see? So, based on my back testing that I've done, and I've gone back about 4 years now, and the range that I keep finding to make everything make sense, as far as going back and literally mapping out peak highs to peak lows, the range is 2.5 times to 4.5 times ADR. So that's the range, the most common range that I found. This is on any pair. So the perfect range is 3 times, but you're gonna find that there's gonna be times where the range might be only 2.5, or maybe 3.5, or maybe 4 times, right? So the more that you do this, you'll start to see what I'm talking about. And again, we're gonna get real deep into it. But that's the most common range I've found, is 2.5 to 4.5 times ADR. So what do these look like? What do these what do these market maker cycles look like, right? Well, here's what they look like. So here's AUDJPY, and you can see from the peak formation low to the peak formation high, this one is 3.7 times the average daily range. And remember, the common one is from 2.5 to 4.5, right? So that's what it would look like. Okay, here's another one. This one is pound JPY, and here's what that one looks like. So here's peak formation low to peak formation high. This one's 4.2 times ADR. Here's another one. Here's what is this, pound USD. This one's 3.8 times ADR. Peak formation low to peak formation high. Okay, so that's what a cycle looks like. Now, let's talk about market maker resets. What the hell is a reset? So remember that I told you that everything is already predetermined. So meaning, if I go back here, meaning that this cycle from 136 down here at the bottom to the very top of like 138, make it 139 to make it simple, right? That was already predetermined, right? That was already predetermined. Okay? So, market resets are a way that market makers are able to go, instead of, let's say, 3.8 times, right? Let's say they want to go, the 800, 900 pips in one direction, right? Well, they can't obviously go there automatically just by going straight up on one cycle, right? Because it wouldn't, there's no way that they could do that, especially like on a pair, like, let's say, like AUD JPY, you know, it would be very hard for them to do that for that specific reason, because they can't move the markets that fast like that and keep everything together. So what is needed for them to happen, or what they do, is they end up basically doing a reset, which resets the ADR so they can go another 3 times in one direction. So let me show you what that looks like. So here we have Euro JPY. You can see where we have a full cycle, which is peak formation high to peak formation low, and then we go up basically one level, right? And then the market maker's like, no, we're not. We're obviously going to keep going down, but we need essentially to have another full cycle start. So what's the way that they do that is they basically create a reset. They go up basically one level, and then they drop and break the previous peak formation low, and then you have basically another cycle, another market cycle, right? So think about this. Think about if this Euro JPY, let's say that Euro JPY, let's say that this pair specifically likes to do 100 pips daily average, right? Let's just keep it simple. 100 pips daily average. So that would make every cycle, from peak formation high to peak formation low, about 300 pips. Make sense? Now, let's say that the predetermined amount of pips that market makers want to go is 600 pips. They don't want to go 300. They want to go 600, right? Well, in order for that to happen, they can't just go down. They can't make one cycle go down 600 pips. Okay? They have to split that into 2 cycles, right? So basically you get one cycle of 300, it goes up, creates a reset, and then gives you another full cycle of another 300 that completes a 600 pip move that they wanted to make, essentially, right? And so that's what a reset is. All a reset is a way to give market makers the ability to keep going in the same direction, because they're not where they want to be at yet. Okay? So, a couple things to keep in mind about market maker resets. The first thing is literally what I just said. Resets happen when market makers need to go further than 3 times ADR in one direction. Most resets happen after confirming a peak formation and going 1 times ADR, meaning that once you have this peak formation low here that you see on Euro JPY, they go up 1 times ADR. So basically they go up 100 pips, right? And then instead of, keeping the trend going up, right? Because you're on everybody thinks that you're in a new uptrend. They don't. They drop it and they break past the peak formation low. That's a reset. So in order for a reset to be valid, it must break the previous peak formation. Okay? So meaning that in order for this reset to be a good reset, price action has to go down and break below that the peak formation low that's there. So it has to break this peak formation low for it to be valid. So what would happen if, let's say, price action goes right back down to that same PFL and then actually goes up, right? Why would that happen? The reason why that would happen is because market makers didn't have enough liquidity, enough people selling to make the buy move that they originally wanted. So basically they made a full cycle, they went up to level 1, and they realized, hey, we don't have enough volume, enough liquidity right now, enough people selling to continue to move up. We need to go back down and tag the peak formation low again so we can get more traders selling, thinking that it's a continuation of a trend to keep going down. But as soon as they get down to that peak formation low, they finally get the liquidity that they wanted, and then they can actually reverse in the original direction that they wanted to go to. And I'm going to show you all this on the charts, so don't worry. So the resets become a new peak formation, and you must have a new full cycle, right? So basically meaning that when you have a full reset, when you have a reset happen, you have to have a full cycle come after it. Meaning you can't have a reset and then just go 2 times ADR and then reverse. You have to have a full cycle. Okay? If it's a valid reset, it has to go another full cycle. That's non-negotiable. Now, here's what a reset looks like on a market. You see you have peak formation high to peak formation low, that's 3 times ADR. You see how you go up 1 times ADR, and then they're like, nah, we got to keep going down. And then you see they break the previous peak formation low, and they keep going down a little bit further, right? And then you see from the reset to peak formation low, that's 3 times ADR, that's another cycle. You can see peak formation reset becomes peak formation high in this case, right? This is on Euro JPY, obviously. Now let's go on to the next one. This one is Euro NZD. You can see from peak formation low to peak formation high is 3.7 times ADR. You come down literally for 1 time ADR. You create a reset. You go up higher because you want to go higher. From peak formation low reset to the peak formation high, that's 3 times ADR. Here's another one on Euro CAD. Same thing. This one only goes up 2.5 times ADR, comes down for 1 time ADR. You have a peak formation low reset and then a full cycle afterwards. So think about this example here. If you take away the reset and you just literally go from the bottom to the top, it would have been around what, 5.5 times ADR or something like that, right? So that's how you know that there's a reset in the middle, right? If you measure from the peak formation low to the peak formation high, and you see that you've already that exceeds 3 times ADR, and goes into 5-6 times ADR, you know that there's a reset in the middle. There's 2 cycles in it. Now your question is, where is the reset? Well, the most obvious thing is to look for the deepest pullback. So let's go ahead and let me show you how to find cycles on any chart. So let's hop into the charts, and then let's go ahead and let me show you how to find the market maker cycle. All right, guys, so now that we're on the charts, let's go ahead and let me show you how to break this stuff down. So first, let's go ahead and pull up a chart, and we're going to do a different chart than any of the ones that I've done before. So let's go ahead and do AUD JPY real quick. All right, so once you get a chart that you want to plan out, okay, remember a couple things. Do a quick recap of everything, right? The pattern that we're looking for is this, right? That's the pattern that we're looking for. If it's going down and then this, if it's going up, right? That's all we're looking for is that specific pattern. Now remember that we want to look for from the top to the bottom, ideally is going to be around 3 times ADR, right? But we know that the actual range, there's a range could go anywhere from about 2.5 to about 4.5. That's times ADR, right? So that's the actual range. Ideally would be 3 times, but this gives us a little bit of leeway that we can use, and you'll see why, because not everything is going to be perfect, obviously. So we just want to make sure that we have this range, and that way it can help us find what we're looking for. So on any chart that you go to, the first thing that you want to do is you want to go ahead and you want to go to the 1 hour chart. Okay. And so you want to start with the most recent price is the first thing. All right. So if we take a look at this particular pair right now, the first thing we need to find out is what is the average daily movement of this specific pair, right? So how do you do that? So you go into our indicators. If you never put the indicators on, all you have to do is just go to indicators here on TradingView, type in FXN, and those are the indicators right there. The only ones that we're concerned with are basically the ones that are made by Rob Minty. That's our programmer, and that's it. So those three. Okay. So for right now, though, we're just gonna hide both of them, and we're gonna leave the one that says Asian session range completely open right now. The reason is because this gives us a quick glance at what the ADR is for this pair. So if we look at this, it says right now the ADR is about 70 pips a day, right? So 70 pips a day, that's our range. So what we're going to do now is we're going to take that range of 70 pips, we're going to times it times 3, and that'll give us our 3 times ADR range, which is about 210. Right, so that's what we have to work with, is 210 pips. That's it. All right. So now what we need to do is, now that we know that, is we need to go ahead and identify what is the fastest way that we can start to unbox actual structure on this chart. The first thing that I do on any chart is find the closest high and the closest low. In this case, it's going to be here and it's going to be here, right? That's our starting point. Now, if we go ahead and we go from bottom to top, what are we looking at here? We're looking at essentially 412 pips, okay? Now, remember that our range, our 3 times ADR range for a full cycle is what? 210. So that means that there's basically 2 cycles in this on this chart here. From here to here, there's 2 cycles. Okay. So what we need to do is essentially we need to figure out, okay, where's the new cycle? Where's the first cycle end? Where does the new one begin? All right. So because we know that there's 2 cycles on this particular movement from here to here, and by the way, we'll just start naming this peak formation low, and then We'll name this one peak formation high. All right. So we know that there's 2 cycles. Because there's 2 cycles, obviously there has to be a reset in this, right? So how do we find the reset? Really, there's 2 ways that you can find it. One is just simply measuring, right, from the bottom to the top here until you get to about 210. Well, here we get to 221, right? And then we have a huge pullback. Look at this section here that has the biggest pullback. Out of all the pullbacks that you see here, this is the biggest one, right? And so another thing that I can use to basically help confirm this is we know that we've already measured it from the bottom to the top here is 225. So we know that right there is a full cycle, which is great. Now another thing we can use to confirm is essentially if we turn on the EMAs, right? If we turn on the EMAs and we're basically looking at the 50, which is this aqua blue line here, and the 200, which is this thicker gray one here. If you see, this pullback went to both the 50 and the 200 EMA, and then it went right back up again. So because we had a huge pullback here that went back to both EMAs, this right here makes complete sense for it to be our reset. All right, because if we measure from the bottom here to the top here, we have well over 3 times ADR, right? So this one's actually 262. So if we take 262 and we divide it by 70, that gives us the second cycle, which will come out to be about 3.7 ADR. Okay, so essentially this right here becomes the peak formation high, and then this right here becomes the reset. Okay, so I'll go ahead and put this down here like this, and then this will become a reset. Now because it's a reset, it becomes also the new peak formation low, right? So I typically put reset / peak formation low because that's exactly what it is. Okay. So that right there is literally how we start. Okay, so now we have something to go off of. So now the next part is, where are we currently right now? If we go from here straight down, you can see we're looking at about 228 right now, from this high to this low, before we see a big pullback here, right? Now, if we start matching this up right now with the EMAs again, you see how this big pullback here pulls almost to the 200. This right here could be, very well, could be a reset right here, because we've already passed the peak formation low of 3 times ADR. Okay, so this would be right here, a peak formation low. This right here, because we had a huge pullback, would be a reset and a new peak formation high, right? Now, we know that this is a confirmed reset because price action broke through the previous peak formation low. Okay, that's how we know it's a reset. So now we have that, we can start literally going back, right? And making sure, because as long as we did this correct, everything else should match up just fine. Okay, so let's go ahead and start doing that. And so I'm basically going to do the same thing. I'm going to measure from the low, which is here, to the high, which is here, to see what we have. And you can see same thing, 369, right? So we know if our cycle is typically 3 times ADR, about 210, same thing. There's got to be 2 cycles in this move here. The question becomes, where are the 2 cycles, right? So again, I start to look at, okay, from this top here, if this is going to be peak formation high, right, and this is our low, where is the biggest pullback happening at? Well, if I look, the biggest pullback seems to be right here, this area, right there, and then right there. So if I'm correct, so if this is correct, this should be basically 1 cycle here, a pullback, basically a reset, and then boom, another full cycle, right? So we're going to do that, and we're going to do that. Now the next thing we need to do is just real quick confirm it by going ahead and putting in our EMAs, and you can see this pullback is the only pullback that we get that goes back and touches the 50. Right, you see all along the whole time, nothing touches the 50 here. This is the only one that does it, right? So that would mean that would be where the reset is, and of course the reset becomes a new peak formation high. So what do we do now is we go ahead and we measure it out just to confirm what we're thinking. Right? So we need to confirm what we're thinking here. So we'll go ahead and grab the measuring tool, and we'll first measure from here, from the wick to wick. You'll see that that's 188 pips. That's basically 2.6 times ADR. Okay? And then from here, from this wick to that wick is 233. And so 233 comes out to be 3.3 times ADR. All right. So we know that this is basically correct. All right. And then now we literally just keep going back, right? We keep going back to another section. So here's our next section, is this big sideways movement here. How do you do this? So one thing that I could definitely right away identify is I want to identify my low, which is clearly right here, right? Because that's going to be a peak formation low regardless, because that's where we're coming off of. All right. And so now the question becomes, from this low to this high, is that possibility for a full cycle? So we go ahead and we measure this out, and it's about 183. So if we take 183 and the average is 70, that gives us about 2.6 times ADR, which is good for a cycle. So from the bottom to the top here, that's basically a full cycle. There's your peak formation high. Okay. Now what we do is essentially we do the same thing. We measure it from the high to the low here, and you can see that it's 151. Okay. So 151 would give us about 2.1 times ADR. That is not enough for a full cycle. Okay, so what do we do with this? Well, as you can see, from the full cycle, we went from peak formation high down, and then we went back up to retest it. Now, I want you to realize something, that what if I replay this here, what if this price action would have kept moving and going straight above? So what if it went like this and it kept doing that? Then this right here would be what? A reset, right? Does that make sense? Because it would have kept going up and it broke this peak formation high, right? So that would have been a reset if that would have happened. But in this case, it did not happen, right? So as you can see, it didn't happen, right? It just went back up to that same level and retested that same level. So what is this called then? So this right here, this area right here, instead of being a reset, it would be a failed reset, because the reset actually failed to produce, right? So we would change this up and call it a failed reset. And that's what that would be. Okay, again, that would be a failed reset because instead of continuing and breaking this high, it didn't do that. It actually just retested that high and then went straight back down again. Okay? So this essentially is how you can go ahead and find actual market maker cycles. And essentially you just keep going from here. That's all you literally do, is you keep going back. The further back that you go, I mean, the more that you're going to become accustomed to seeing it. This is going to take practice. We're going to spend so much time doing this because it's such a huge, big deal that you understand how to do this and how to do it properly. This right here is what gives you your advantage. It's one thing to know the patterns of type 1, 2, 3, or 4 that we trade, but how do you know what patterns you should be looking for? Essentially, what is your directional bias? And this right here, understanding this and mapping this out is going to give you your directional bias. And that right there is your edge to begin with. Because if you know that you're looking for sells, then the only patterns of type 1s, 2s, and 3s that you're 4s that you're taking on this way down is going to be sell options. You're not going to be looking for buy options, which are buy options are basically a trap. Okay? So that's why we're literally jumping from week 1. We're not worried about the patterns right now. We're worried about being able to identify basically the hardest thing, which is getting to understand what the cycles look like on the chart. And so let's go ahead and keep going. Let's go do one more to keep this going. See how far back we can go. So we have this peak low here. What my next move is going to be would be basically to measure out from here to the next high, which would be here. That's 211. That actually would be a full cycle, right? Now, if we measure from the bottom back up to the top, it'd be about 300 pips. So doing the math, if we know that each cycle is 210, this won't give us enough to do 2 cycles, right? It's just not possible. The numbers won't add up. But from the top there to the bottom is 300 pips, right? 300 pips, if your average daily range is 70 and you got 300 pip range, that's 4.2 times ADR. So what it would be is basically this would be your peak formation high here. This would be your peak formation low. From here to here is 4.2 times. Now, you can already see, or you should be already able to see that from here to here, there's no way that's a full cycle. It's only 149, same thing as what happened here, right? So we know that not only is this a peak formation high, but this is actually a reset. This is actually a reset also, because this is the closest peak formation low. Okay, and then now we're going to continue just to measure on from the low to the top. So you have 200, which could be a full cycle, but again, the same problem, right? If you go up to the very top here, 286 is basically the same problem from here, right? So this would actually be a full cycle from here, like that. Okay. Now, this being about 277, 279 or so, what that would be essentially, that would be 3.9 times ADR. Okay. So now, here we go. If we go back now and we measure from here to here, again, same thing, not enough for a full cycle. But notice the behavior that comes from this top here to the bottom, back up to retest that same high. What does that look like? It looks like we just did that one, didn't we? Right here. So this right here, if this is another peak high, I'm going to assume that if we measure from here to here, this would be a full cycle. If that's correct, this would be another failed reset. Because it's not a full cycle coming down, and it just went back up to retest. If it would have went like this and kept going, broken that high, then this would have been a good reset, right? But it didn't do that. It just retested that same high there. So it's a failed reset. So now let's go ahead, and this would be your new low. This would be peak formation low. This would be peak formation high. And then we literally just keep this thing going, right? That's all we're doing, is literally keeping this thing going. So we go back up and we basically go from the top to the bottom here. Same thing, 291. So we know that this is a full cycle from here to here. Now, I want you to notice that there's a lot of sideways movement happening here. Okay, where's the very top at to begin with? The very top is right here, right? So we know that that's going to be our peak formation high. We know that from this bottom to this top here would be about 3.2 whatnots ADR. Or not 3.2, but closer to 4.0. So now the question is, if we measure from here to here, is that a full cycle or is it not? So from here to here is what? 187. So 187, and 70, that would be 2.6 times ADR. So that would be a full cycle. We could use that as a full cycle. Right? And so now we measure from here to the top. Obviously, that's not going to be a full cycle. So what does that leave us with the opportunity for this section up here to be? If we're at a peak formation low here, we go up maybe 1 times ADR, maybe 1.5, but then we drop off, right? That would basically mean that this area is a reset, just a regular reset, and a peak formation high, because we know that from here down to there is about 4 times ADR. Okay, and so you just literally keep it going, guys. But this is how you break down the market maker cycle on any chart. Okay, if you have problems trying to find resets, I think the biggest thing that I find with most people when they first start doing this is that they get lost in the resets, either a failed reset or just a reset in general. Okay, so just remember that if you cannot make it work, like we found a couple times, like here, you know, from here to here, because we couldn't make the math work of 2 cycles, right? You can make it 1 full cycle. That's completely fine as long as it fits within the parameters of 2.5 to 4.5. Okay, because you can see when we use those specific parameters, you can make it work all the way back, and you can keep going and make it work. Okay, so this is best performed on a 1-hour chart, And like I said, the only things that you're going to use the EMAs for primarily is to help you find the resets if you're not sure where they could possibly have been. And all we're looking for, as far as the reset goes, is just to pull back to the 50 or pull back to the 50 and the 200 like we see here, or just pull back to the 50 here, pull back to the 200 here, things of that nature. Okay? So that's all that we're looking for, guys. That's it. But that is how you break down a chart. So let's do one more so I can give you a different example of a different pair. So let's do pound JPY. So on pound JPY, it's the same thing that we literally just went through on the other pair, right? It is 1 hour chart. Let's first identify what's the average range on this pair. So we turn on the Asian session range and let's get the number. So 80. So 80 pip. 80 pips is our range. Okay. Now let's just start with the obvious point here of where's the closest peak, the closest high that we can get a full cycle from, right? So that's obviously going to be here at the very top here, and then the low obviously is going to be here. Okay, so same thing as before. We'll do peak formation low, and then we'll do peak formation high right there. Now we go ahead and we take our 80 pips, and we take 80 times 3 is about 240 is what our cycle is. So let's measure from the top to the bottom here, and we could see we get 375. So clearly we're way over. Way over the 240 mark, right? So one thing we could do is, if we do the math on this, if we do from here to here, and it's about 80 pips or so, I mean, technically it's about 4.6. It's about 4.6 times ADR, okay? But let's see if we can make this work with 2 cycles within it, just so we can make sense of it better. So if we turn on our EMAs, what major pullback comes to mind here within this cycle that would give us enough room for 2 cycles for it to make sense, basically, right? I'm looking at this, and obviously this pullback here is way too, is too far away. This pullback here seems to be the one that should be the dividing partner here. So the question becomes, if we measure from the bottom all the way to the top, there you go. 247 pips from the top to the bottom. There's your first cycle. So this right here would be your peak. And then clearly we know that that's not a full cycle, so we know that this is a reset. So we do that. We put that here like this. And we'll rename it for a reset here. So there you go, right? And then we know, of course, from here to here, there's going to be plenty of room for a full cycle. Yeah, 235, perfect. So we have basically enough room for 2 cycles right there. And now we can just literally start moving back now. So basically the same thing is we start measuring out from this low here to this high is about 416. Basically the same thing we just literally went through on the previous cycle over here. So we know that there's definitely 2 cycles here. If you look on this chart, without even putting on the EMAs, where do you think the reset is on this? Right? Because we know it's 2 cycles because of the amount of pips from the high to low. So there's a reset here. Where's the most obvious place for that to happen? Think about where's the biggest pullback at. Right, so if you look, the biggest pullback is right here, right? So this right here is going to be your reset. That'll be your peak formation low. This right here would be your reset, peak formation high. And then from there, this would be up here, obviously your new peak formation high. Okay. So now if we move over and we just keep it moving from this high to this low, 214, from this high to that low, 220, 229. So what happens if we take 214, so from here to here is about 2.6 times ADR, and then from here to here being a little bit more, it's going to be about 2.7 times ADR. Okay. Now, I want you to think about something. Think about a situation. Well, what if this peak formation was not 3 times ADR? Let's say it was only 1.5. What would this be instead then? If it's not a peak formation low, what would that change to then? So this right here would change to a failed reset because price action went back up to retest the high here and it never went higher, right? So it never did essentially this, okay? So because it didn't do that, it would be a failed reset if that's the case. But we know it's not a failed reset because we can meet the criteria from here to here and then from here to here as being 3 times ADR. Okay. Now, clearly, here's an example right here of actually a V-shaped bottom. This is actually another one as well, a V-shaped bottom. There's a couple of them now, so you can see what they look like, right? So you know clearly this is going to be a peak formation low. We know that. Okay, so the question becomes, all right, well, what's from this low to this high here? What is that? It's 504. So 504. So we know for sure that there's a reset. Question is, where's the reset? Where's the reset? If we turn on the EMAs to help us, right, we can see that there's 2 big pullbacks, one here and another one here, right? So those are going to be our areas of focus of where the resets are. So if we go from the bottom here to the top here, it's 400, to this first one here is about 378. So if we take that into consideration with the 80, that'll give us about 4.5 times ADR. And then from here, this bottom to this top, there's about, what, 207 or so. So 207, that'll be about 2.5 times ADR. So this right here would be your peak formation. This right here would be your reset. And then this right here would be your peak formation high. Okay? So now we keep it moving. Same thing. Just keep moving. So from here to here, 500. about 500 or so. So same thing, we're going to turn on the EMAs, and we're going to see where's the deepest point that we can get to whenever with a retracement. So that's going to be this area here. So how big is it from here to here? So it's about 191. So this is about 2.5 times ADR. And then clearly we're going to have a full cycle down here as well. And so that cycle right there would be about 4.5 times ADR. Okay, so here's your peak, here's your cycle, there's your reset. And same thing, we keep it going from there. So from here to here, about 284, that's a full cycle there. That's good. And we just keep going with this, guys. Same principle. And we keep going back and forth, back and forth, back and forth. But now, we just did what? From current date to July. So we did 1, 2, about 3 months. Okay, but that's how you start to put together the market maker cycles. All right. All right, so I showed you how to find cycles on any chart. I also showed you how to find resets on the charts as well. So we should have a good foundation, essentially, of how to find the market maker cycle, and then the resets that you're going to get along the way, because they're going to happen. One of the things that I've noticed over the years is price action or market maker cycles having a lot more resets in recent years than they've ever had before. Before, resets weren't that common, but now they seem to be very, very common because of the bigger moves that we're seeing market makers make. All right, so now let's go ahead and talk about homework. So what I'd like you to do for homework is, first of all, turn in the questions at the beginning of the video. Okay, that's one. Second is, I want you guys to do AUD CAD, Pound Swiss, NZD JPY. Okay, I'm picking these pairs specifically because of the fact that you guys already see my charts throughout the group sessions of Sunday and stuff like that. So you guys already know what the majority of the pairs, what they look like, where the resets are and stuff like that. So these pairs I don't ever cover. So I know that you guys should be able to mark these up, and you'll be doing it yourself, right? You wouldn't be looking at my charts from previous group sessions. All right. So the job here is basically to find the market maker cycle. Okay. Find the cycles. I want you to basically break down the charts exactly how I did for you in this video. I want you to highlight the charts, right? Highlight the peak highs, peak formation highs, peak formation lows, resets if there are any. But then also, I want you guys to write down on those charts the actual ADR for each cycle, right? So let me hop back over to the chart so I can show you real quick. All right, so here's what I want you to do. On the charts here on TradingView, you're going to have an option on the side here. Right here, if you click on this box, there's going to be a curve option here, which is this. If you tag it from here down to over here, it will create this little arc. This is the arcs that I use, right, for pointing out peak highs to be closed. And so I want you guys to do the same thing, but then also go ahead and use the text box to tell me, hey, this was, 7.3 times ADR, right? So like this, right? So you're going to have your charts basically look like this, right? And whatever the ADR is, you're going to change it, obviously, for each one. But you're essentially going to have your chart looking like this. Boom. Okay, so you're going to go all the way back, right? So that way I know what the range is that you've calculated and stuff. Make sure that all your charts are labeled correctly like this. Okay, I don't want anything else besides this. You have to understand that I'm grading each one. I'm literally looking at each example that you send me, and I'm giving you feedback on it. So it's hugely important that you have this correctly labeled, because I have a lot of people to go through homework with. Okay. So here's what I want you to do: is I want you to have them labeled like this, and then I want you to go ahead and give me 3 months of data. So the last 3 months of data. So let's say September, August, July. Yeah, July, August, September, basically, worth of data on those 3 pairs. So that's going to be your homework. Remember, label all peak formation highs, lows, and resets. And if it's a failed reset, cool. Name that as well. You might get some, you might not. I don't know. Okay. Now, another thing that's very important is you're going to email me links. Okay. So here's what I want you to do, right? Obviously, you may not be able to fit, the entire thing like this to where it's actually like readable, right? So you may have to do like maybe 1 month at a time or something like that. Maybe like do, I don't know, September, from the first, just do the whole month of September, and then go up here to the camera icon, where it says take a snapshot up here, and then you're going to click on copy link to chart image. Okay, and then you're going to get this icon here that says link chart. It's basically just copied it copied the link to that chart, and then all you're going to do is literally paste that link into your email. Okay, and it's going to look like this. So your email should look like this. It should have the pair and then literally just links. Okay, just links. That's all I want. Links. I don't want anything else. I don't need a fancy spreadsheet. I don't need any of that stuff. I literally just want the links. That's it. So this is how your email should be. Okay, pair and then just send me the links like that. All right, you're gonna send the email to fxnmentoring@gmail.com. This email that you see on the chart here, fxnmentoring@gmail.com. Okay, is where you're gonna send it to. All right. So that's what I want you to do for homework this week. All right. Don't think that this week specifically is just going to be, this is the only opportunity we're going to get about talking about peak formation highs and lows, because it's not. This is literally just the beginning, and I wanted to get this done at the very beginning so you can guys get the hardest part out of the way. Okay. So that is going to be week 1. All right. If you have any questions or anything like that, please email me or chat me in the Discord group. Send me a message. All right. Guys, thank you so much. I hope you've enjoyed week 1, and have a great week, and we'll see you in the group session.